IAS 28, investment in associates and joint ventures. Investment in associates and joint ventures. In this presentation, I want to provide a further work example on IAS 28 using question from ICANN November 2021, corporate reporting, question number 1. Now, the question. This is ICANN November 2021, corporate reporting, question number 1. Makoko International Holding Limited is a global merchant of cash crops. A policy of strategic acquisitions over the years has placed the company in the prime of place to source for export products competitively. The lockdown arising from the recent pandemic posed a significant challenge for the export of their products throughout the year 20XX. At a board meeting to review the performance of the company for that year and discuss the impact of the pandemic, the managing director noted the significant drop in the general performance indices. In order to get a greater market presence and higher demand locally, the board decided to acquire the following investment on January 1, 20X1. 60% of the equity shares of Ojodu Limited, 50% of Ojodu's 10% loan notes at par, 40% stake in the ordinary shares of Egbeda Confectionaries Limited. In the opinion of the board, both Ojodu Limited and Egbeda Confectionaries Limited are the biggest local customers of Makoko Intercontinental Holdings Limited, and a control through shareholding will give the investing company greater stake in the operational decisions of the investee companies. Importantly, it will also boost revenue by allowing unrestricted access to local markets. It is believed that this will forestall any adverse impact of further lockdown that may hinder export sales in the future. The draft financial statements of the companies for the year are as follows. We have the statement of financial position as at December 31st, 20X1. We have for Makoko, we have Ojodu's, we have Makoko Limited, we have Ojodu's Limited and Egbeda's Limited. We have assets, non-current assets, which include freehold properties of 85,250, 62,000, 75,500. Plant and equipment, 46,705, 42,405, 21,820. Investment in subsidiaries, 136,000. The total of non-current assets of Makoko Limited is 267,955. And that of Ojodu Limited is 104,405. And then that of Egbeda is 97,320. we have the current asset. Current assets, which include inventories, 42,100 for Makoko, 38,150 for Ojodu, and Egbeda we have 49,240. We have trade and other receivables of 12,850, 11,200, 4,500 for Makoko, Ojodu, and Egbeda respectively. Cash and cash equivalents of 32,720, 14,100, and 5,600. We have the total of the current assets to be 87,670 for Makoko, 63,450 for Ojodu, and 59,340 for Egbeda. Total assets 355,625, 167,855, 156,660 for Makoko, Ojodu, and Egbeda respectively. We have the equity and liabilities. The equity, we have ordinary shares of 1 naira each, 180,000, 100,000, and 85,000. Retained earnings, 45,455, 22,225, and 17,000 for Makoko, Ojodu, and Egbeda respectively. We have the total equity to be 225, 455, and 122, 225, and 102,000. That is the total equity. Then we have the non-current liabilities. We have the 8% loan notes. Makoko, we have 28,000. 8% loan notes. Makoko, 28,000. Then we have 10% loan notes. Ojodu 10,000 and 12,500 for Egbeda. Then we have deferred taxation 60,308, 8,440, and 16,000. Total non-current liabilities of 88,308, 18,440, and 28,500. Then we have the current liabilities. Current liabilities include trade payables of 25,222, 15,185, 14,346 for Makoko, Ojodu, and Egbeda respectively. Then we have accruals 7,820, 5,525, 6,589. We have provisions 8,820, 6,480, and 5,225 for Makoko, Ojodu, and Egbeda respectively. Total current liabilities, we have 41,862, 27,190, we have 26,160, and then we have the total liabilities and equity to be 355,625, 167,855, and 156,660 for Makoko, Ojodu, and Egbeda respectively. Additional information. Makoko Limited paid 90 million naira for the acquisition of Ojodu Limited when the retained earnings of Ojodu Limited were 30 million naira. 2. The fair value of Ojodu's freehold property was 6.5 million naira. Was 6.5 million naira higher than the carrying amount as at the date of acquisition. This valuation has not been reflected in the books of Ojodu Limited. 3. Makoko Limited paid 41 million naira for the shareholding in Egbeda Limited when the retained earnings of Egbeda Limited were 12 million naira. Note 4. An impairment test as at December 31st, 20x1 showed that goodwill was impaired by 3.5 million naira. And the investment in Egbeda Limited was impaired by 0.8 million naira. Note 5. During the year, Makoko Limited sold products to Egbeda Limited at a price of 8 million naira. These goods had cost Makoko Limited 5 million naira. Half of the goods were still in the inventory of Egbeda Limited as at December 31st, 20x1. Six, the company issued share. The company's issued share capital has not changed since the date of acquisition. Note 7. No dividends were paid during the year. Note 8. Non-controlling interest in subsidiaries are to be measured at the appropriate proportion of the subsidiaries' identifiable net assets required. Prepare the consolidated statement of financial position for the Makoko's group for the year ended December 31st, 20x1. That is the question. ICANN November 2021. Corporate reporting, question number 1. Solution. So the first thing is the group structure. Group structure. We were told that the board decided to acquire the following investments. 60% of the equity shares of Ojodu Limited. So that means Makoko Limited acquired 60% of the equity shares of Ojodu Limited. 60% of Ojodu Limited. And we also told that Makoko also acquired 50% of Ojodu 10% loan notes. I want you to know that investment in loan notes does not determine the parent and subsidiary relationship. So it doesn't determine the parent and subsidiary relationship. The third bullet, 40% stake. 40% stake in ordinary shares of Egbeda Confectionery Limited. 40% stake in ordinary shares of Egbeda Confectionery Limited. 40% in Egbeda Confectionery Limited. That is the group structure. The next thing is the summary of the net assets of Ojodu and Egbeda Limited. We want to present the summary of Ojodu Limited net assets and the summary of Egbeda Limited net assets. That is the next step. The next step is the summary of the subsidiary net assets. Working 1. Summary of Ojodu Limited net assets. If you have watched my earlier presentation on consolidated financial statements, I've told you that net assets are the equity. So we have the post-acquisition retained earnings, post-acquisition retained earnings. We have for the date of acquisition, and we also have the date of consolidation. So all amounts are in thousands. So now, let's go to the equity section of the statement of financial position of Ojodu Limited. The equity section, we have ordinary shares of 1 naira each. That of Makoko Limited is 180,000. Then for Ojodu, we have 100,000. We also have retained earnings. That of Makoko is 45,455. And retained earnings of Ojodu is 22,225. So what we need is 100,000 and 22,225. Now, let's add them. So we have ordinary shares. Ordinary shares. Ojodu is 100,000. Retained earnings for Ojodu is 22,225. 22,225. Then let's also have the summary of Egbeda net asset. Summary. Let me say working 2. Summary of Egbeda Limited. Net assets. We have post-acquisition retained earnings. Post-acquisition retained earnings. We have the date of acquisition. We also have date of consolidation. All amount in 1,000. So the net assets also include ordinary shares and retained earnings. Now, let's go back to the net assets. We have ordinary shares. That of Egbeda is 85,000. And retained earnings of Egbeda is 17,000. So we have 85,000 and 17,000. Total 102,000. So we have ordinary shares 85,000. Retained earnings 17,000. 85,000 ordinary shares and 17,000 retained earnings. Additional information. Note 1. Makoko Limited paid 90 million naira for the acquisition of Ojodu Limited. This 90 million represents the consideration transfer, that is the price paid by the parent to acquire Ojodu Limited. And remember, Ojodu Limited is the subsidiary of Makoko Limited. Since the stake of Makoko Limited in Ojodu Limited is 60%, which is above 50%. When the retained earnings of Ojodu Limited were 30 million, this is the retained earnings of subsidiary as at the date of acquisition. That is 30 million. Now, let's go and fix it in. So, we have, this is the date of acquisition. The retained earnings at the date of acquisition is 13,000. That of Ojodu Limited is 13,000. Ordinary shares at the date of acquisition will still be 100,000, since there is no further issue of shares after acquisition. Therefore, post-acquisition retained earnings will be 100,000 minus 100,000. Then we have NIM for ordinary shares. Then that of retained earnings. Then you have 22,225 minus 13,000. That will give us 9,225. Therefore, post-acquisition retained earnings of Ojodu Limited is 9,225. Note 2. The fair value of Ojodu's freehold property was 6.5 million higher than the carrying amount as at the date of acquisition. There is a fair value gain. This is fair value adjustment, which arises as at the date of acquisition. That means you are going to incorporate this fair value gain to the date of acquisition, since it occurs at the date of acquisition. The valuation has not been reflected in the books of Ojodu Limited. Now, let's have fair value adjustment. Fair value gain. So we have 6.5 million. 6.5 million. It occurs at the date of acquisition, so we are going to add the 6.5 million to the date of acquisition. So we are not going to have it in post-acquisition period. So that is for that. Now, let's have note 3. An impairment, note 3. Makoko Limited paid 41 million for the shareholdings in Egbeda Limited when the retained earnings of Egbeda Limited were 12 million. That the 41 million is the consideration transfer. That is the price paid by the parents to acquire its stake in Egbeda Limited. Remember, Egbeda Limited is an associate of Makoko Limited. Since the stake of Makoko Limited in Egbeda Limited is just 40%. 40% is sufficient to give Makoko Limited a significant influence in Egbeda Limited. But Makoko Limited cannot control Egbeda Limited. That is to show that Egbeda Limited is not a subsidiary of Makoko Limited, because the stake of Makoko Limited in Egbeda Limited is not more than 50%. So you only have a subsidiary where the stake of the investor in investee is more than 50%. But since 40% is not up to 50%, that means Egbeda is an associate of Makoko Limited. So we are going to apply IAS 28 to the stake of Makoko Limited in Egbeda Limited, which is a significant influence. So the retained earnings as at the date of acquisition, retained earnings of Egbeda Limited were 12 million. So that is the pre-acquisition retained earnings of Egbeda Limited. So you have retained earnings. The one as at the date of acquisition is 12 million. The ordinary shares at the date of acquisition will still be 85 million. So post-acquisition need then 17 million minus 12 million. The post-acquisition retained earnings of Egbeda will be 5 million naira. 5 million naira. So now, when you sum up this, the total of this remain 102,000. Then the total of these is 97,000. And this remains 5,000. Now let's go back to note 4. An impairment test as at December 31st, 20x1 showed that goodwill was impaired by 3.5 million. This is the impairment of goodwill. After computing your goodwill, you are going to charge the impairment loss to, you are going to charge it against your goodwill. So remember, the accounting principle is the principles of double entry. So you also charge it to the retained earnings, but depending on the parent company policy. But in this question, you were told that the policy is proportionate share of net assets. So since it is proportionate share of net asset, so you are going to charge this to the retained earnings. You charge it against the retained earnings of the parent company. And the investment in Egbeda Limited was impaired by 0.8 million. So this is the impairment of the investment in associate. So you are going to deduct it from the investment in associate. Then you also charge it against the retained earnings of the parent. 5. During the year, Makoko Limited sold products to Egbeda Limited at a price of 8 million naira. This is an intercompany transactions. Of course, this is a sales of inventory from the parent, the investors, from the investor to Egbeda. So we call this a downstream transactions. So this is sale by the investor to the associate, so which is a downstream transaction. If you have gone through my earlier presentation on IAS 28, investment in associate and joint venture, then you'll be able to understand how downstream transactions will be treated. So since this is a downstream transaction, that is a downstream where investor sells to an associate, where investor sells to the investee, that is what we call a downstream. A downstream transaction is a transaction between the investors and associates, where the investor is the seller. I repeat, a downstream transaction is the transaction between the investor and the associate, where the investor is the seller. So, for our purpose now, we want to calculate the goodwill on acquisition of the subsidiary. Now, let's sum up the net assets. We have 100,000 plus 22,225 plus 6,500. Then we have 128,725. Then we have 100,000 plus 13,000 plus 6,500. Then we have 119,500. Now, we want to calculate goodwill on acquisition of Ojodu. Let me have working 3. Acquisition of Ojodu Limited. So we have purchase consideration or consideration transfer. Consideration transferred, and that is note 1. We were given the purchase consideration to be 90,000. The purchase consideration is given to be 90,000. So we have 90,000. In note 8 of the question, which I've rubbed off from the board, you were told that non-controlling interest in subsidiary are to be measured at the appropriate proportion of the subsidiary's identifiable net assets. Non-controlling interest in subsidiary are to be measured at the appropriate proportion of the subsidiary identifiable net assets. Remember, the stake of Makoko Limited in Ojodu Limited is 60%. That means the remaining 40% will be attributable to non-controlling interest. So now let's have our non-controlling interest, NCI at acquisition. So, which is the percentage attributable to NCI is 40%. 40% of the net assets at the date of acquisition, and that is given to be 119,500. 119,500. So 40% of that, then you have 47,800. 47,800. Don't forget, I've told you that where the purchase consideration is given in the note. Where the purchase consideration is given in the note, and another one is given in the statement of financial position. Whenever you are calculating goodwill, it is the purchase consideration given in the note that should be used in the calculation of goodwill figure, not the purchase consideration given in the statement of financial position. That is why we are not using the consideration given in the statement of financial position. That is why we are using the consideration given in the note 1, so which is 90 million. So 47,800 plus 90 million. Then we have 137,800. So now let's net assets. Net assets at the date of acquisition. Our net assets at the date of acquisition is 119,500. 119,500. So when you subtract 119,500, then you have the goodwill minus 119,500. So we have 18,300 as our goodwill. 18,300. That is our goodwill. 18,300. Back to note 4. You were told that an impairment test as at December 31st, 20x1 showed that goodwill was impaired by 3.5 million. So that means we are going to impair our goodwill. We have our impairment loss. Impairment loss of 3.5 million. So if you subtract 3.5 million from the goodwill, you are going to have minus 3.5 million. So the figure of goodwill to be consolidated will now be 14,800. So that is the goodwill that will appear in the consolidated statement of financial position. Then, having computed our goodwill, the next thing is that we are going to calculate the investment in associate. Investment in associate. I've told you that equity method of accounting should be used to account for investment in associate, where the entity has other entity as a subsidiary. You are going to use equity method now. But where the entity does not have a subsidiary, you are going to use the IFRS 9 fair value, financial, you are going to use financial instrument, IFRS 9. So, working for, you have investment in associate, and our associate is Egbeda Limited. So we want to calculate the investment in Egbeda Limited. We are also going to use the consideration given by the way of note. So we have consideration transferred. Remember, equity method of accounting in accordance with IAS 28 is to be used. So how much is the consideration? Back to note 3. Makoko Limited paid 41 million for the shareholding in Egbeda Limited. The consideration is 41 million. So we have 41 million as the consideration transferred. So we now have Makoko Limited share of post acquisition retained earnings of Egbeda Limited. So, which is, the stake of Makoko Limited in Egbeda is 40%. So we have 40% of the post-acquisition retained earnings of Egbeda. The post-acquisition retained earnings of Egbeda is 5 million. So 40% of 5 million. 40% of 5 million. Then you have 2 million. 2 million. Then we also have provision for unrealized profit. Provision for unrealized profit. So, back to note 5. During the year, Makoko Limited sold products to Egbeda Limited at a price of 8 million naira. That is the amount the product was sold. This good had cost Makoko Limited 5 million. The cost price is 5 million and the selling price is 8 million. That means profit of 3 million has been recognized on that transaction. So, since there is a profit of 3 million and we were told that half of the goods were still in the inventory of Egbeda Limited as at December 31st, 2021. I've told you that unrealized profit should be calculated on the unsold items of inventory. So, since half are still in the inventory, that means to calculate your unrealized profit, half of, the profit is the difference between 8 million and the 5 million. So, this is the profit. So, 8 million minus 5 million, that gives us the profit of 3 million. Half of 3 million, that will be 1.5 million. That 1.5 million represents the profit on the portion not yet sold, since unrealized profit should be calculated on the unsold items of inventory. Therefore, I've told you that it's not the entire profit of 1.5 million you need. It is the one attributable to the parent. The one that belongs to the parent, based on the parent's stake in the associate, which is 40%. If you calculate 40% of 1.5 million, you know the difference between this is 3 million. Half of 3 million is 1.5 million. 40% of 1.5 million, that will give us 600,000. That is the unrealized profit, the portion attributable to the parent. Then we also have impairment loss. Impairment loss. You were told that the investment in associate was impaired. Back to note 4. An impairment test as at December 31st, 2021 showed that goodwill was impaired by 3.5 million and the investment in Egbeda Limited was impaired by 0.8 million. So this is the impairment of the investment in associate. So now you are going to deduct the impairment loss of 800,000. So if you subtract that 0.8 million, that is, now how much will now be the investment in associate? 41,000 plus 2,000 minus 600 minus 800. So the investment in associate will be 41,600. That is the amount of investment in associate that will be recognized in the consolidated statement of financial position. Now, having done that, so now let's prepare of investment in subsidiaries. Investment in subsidiaries. We want to reconcile this investment. We want to see if it agrees with the figure given in the statement of financial position. But where the figure of investment in subsidiaries given in the statement of financial position, where it is greater than the sum of the individual investments given in the note. Therefore, the difference, the amount by which the one given in the statement of financial position exceed the figure of the investment in the note will represent other investments or simple investment in the consolidated statement of financial position. Now, let's see that. If you check note 1, you see that Makoko Limited paid 90 million for acquisition of Ojodu Limited when the retained earnings of Ojodu Limited were 30 million. So, Ojodu, let me say investment in Ojodu Limited ordinary shares. Investment in Ojodu Limited ordinary shares, and that amounted to 90 million. It amounted to 90 million. Then if you go back to the note, you were told that the board decided to acquire the following investments on January 1st, 20XY. 60% of the equity shares of Ojodu Limited. This 90 million represents the price paid by Makoko Limited to acquire that 60%. Then 50% of Ojodu, 10% loan notes at par. Investment in 10% loan notes of Ojodu Limited. You know, he acquires 50% of Ojodu Limited, 10% loan notes at par. That means 50% of the par value of Ojodu Limited loan notes. Now, let's go to the statement of financial position. So, 10% loan notes, and that amounted to 10,000. 10% loan notes amounts to 10,000. So, 10% loan notes, that is 10,000. So, meaning that 50% of that 10,000 was acquired. 50% of 10,000, that is 50% of 10 million, that will give us 5 million. Then, you were also told that 40% stake in the ordinary shares of Egbeda Confectionery Limited. So, there is another investment. Investment in Egbeda ordinary shares. So, no, he acquired 40%. How much is the consideration? Note 3. Makoko Limited paid 41 million for the shareholding in Egbeda Limited when the retained earnings of Egbeda Limited were 12 million. The price paid by Makoko Limited to acquire that stake in Egbeda Limited is 41 million. So, 41 million. If you now sum up this, so 90 million plus 5 million, that will give us 95 million. 95 million plus 41 million. Then we have 136 million. The sum of the three investments agree with the 136 million given under non-current asset in the statement of financial position of Makoko Limited. But where this 136 million exceed this amount, the difference will represent other investments or simple investments in the consolidated statement of financial position. So we can now have Makoko Limited Group consolidated statement of financial position as at December 31st, 20x1. So we are starting with the assets. The first asset to start with is a non-current asset. Non-current assets. Our non-current assets comprises 1. We have freehold property, 85,250 for Makoko Limited. That of Ojodu Limited is 62,000. That of Egbeda Limited is 75,500. Remember, Egbeda Limited is an associate. We don't use to consolidate an associate. We don't use to consolidate an associate, so you will only consolidate the Makoko Limited and Ojodu Limited. So we have 85,250 for freehold property. Now let's have freehold property. Freehold property. That of Makoko Limited is 85,250. That of Egbeda is 62,000. 62,000. If you go back to note 2, you have the fair value of Ojodu freehold property. You were told it is 6.5 million. 6.5 million higher than the carrying amount. The fair value of Ojodu's freehold property was 6.5 million higher than the carrying amount. So we are going to add the 6.5 million. That is fair value increase. So we have 85,250 plus 62,000 plus 6,500. So that is totaled 153,750. So we also have plant and equipment. Plant and equipment 46,705 and 42,405. Now let's have that. Plant and equipment. That of Makoko Limited is 46,705 and that of Ojodu Limited is 42,405. I told you that we are not going to consolidate Egbeda Limited. So we add the two. 46,705, 46,705 plus 42,405. there is no adjustment on plant and equipment. So 46,705 plus 42,405. That is totaled 89,110. Then back to the statement of financial position, we have investment in subsidiaries which have been used to calculate our goodwill. Now, note 3. In our note 3, we have acquisitions of Ojodo Limited. Upon acquisition of Ojodo Limited, we have goodwill of 14,800. We are going to recognize our goodwill as a non-current asset. So now, they have goodwill, that is working 3, 14,800. Then working 4, we also have investment in associates, that is investment in Egbeda Limited. And we have 41,600. 41,600 as investment in Egbeda Limited. Investment in Egbeda Limited of 41,600. That is working 4. We have investment in Egbeda Limited. That is working for 41,600. When you sum up these, you have the total of our non-current asset: 153,750. 153,750 plus 89,110 plus 14,800 plus 41,600. Then we have 299,260. That is our total. That is the total of our non-current assets. The next thing after non-current assets will be the current assets. Current assets include, number 1, inventories. Inventories. So we have inventories. Inventories of Makoko Limited is 42,100. That of Ojodo Limited is 38,150. And inventory of Egbeda is 49,240. Remember, Egbeda is an associate. We don't use to consolidate an associate. So we only add the inventory of the parent and that of the subsidiary. So we have 42,100 plus 38,150. So if you sum it up, 42,100 plus 38,150, then you have the total to be 80,250. Remember, the only items of transfer of inventories we have in this question is the sales by the parent, that is by Makoko Limited, to an associate. And remember, I've told you that since there is transfer between the investor, that is the Makoko Limited, and the associate, an associate is the buyer, the inventory of the associate will include the items transferred by Makoko Limited. And since the inventory of associates includes that, and we don't use to consolidate an associate, therefore, the unrealized profit on transfer will be deducted from the investment in associate. And that is why if you have showed our earliest working, the unrealized profit was deducted from the investment in associate. I've told you that it is only the investor share of the unrealized profit that will be deducted. So not the entire unrealized profit. The investor share of the unrealized profit is what will be deducted. The next item is trade and other receivables. Trade and other receivables. Trade and other receivables. That of Makoko Limited is 12,850 and that of Ojodo Limited is 11,200. So we have 12,850 plus 11,200. Remember, we don't use to consolidate an associate. That is why that of Egbeda Limited will not be considered. But remember, there is no intergroup receivable in this question. So that is why we only consolidate the receivables in the statement of financial position. So when you sum it up, you have 24,050. 24,050. The next item is cash and cash equivalent. Cash and cash equivalent. So we have cash and cash equivalent. That of Makoko Limited is 32,720. And the cash and cash equivalent of Ojodu is 14,100. So we sum it up. 32,720 plus 14,100. 32,720 plus 14,100. So the total is 32,720 plus 14,100. So the total is 46,820. 46,820. So when you sum it up, 46,820 plus 24,050 plus 80,250. So you have the total to be 151,120. 151,120. That is the total of our current assets. If you now sum up the current assets and the non-current assets, the current asset, you know your non-current assets include the freehold properties, the plant and equipment, the goodwill and investment in Egbeda, and the total of our non-current asset is 299,260. If you now add it to our current asset, the total of our current asset is 151,120. 151,120. If you add it to 299,260, so plus 299,260. So you have the total assets to be 450,380. That is our total assets. Total assets. After total assets, the next section of the statement of financial position will be equity and liabilities. Equity and liabilities. So equity and liabilities. So we start with the equity. You now go back to the equity section of the statement of financial position. The equity section of our statement of financial position. So if you go to the equity section now, so in our statement of financial position, so as part of our equity, we have ordinary shares of 180,000 for Makoko Limited. That of Ojodu Limited is 100,000, and that of Egbeda Limited is 85,000. So only the ordinary shares of Makoko Limited, which is 180,000, will be considered. So we consider the ordinary shares of Makoko Limited, which is 180,000. Ordinary shares of Makoko Limited of 180,000 will be considered. So we have ordinary share, which is 180,000. Then after ordinary share, the next thing is our retained earnings. Retained earnings. Let's have that to be working 5. Working 5. So we want to consider that as part of our workings. So we haven't considered the ordinary share. The next thing is the retained working 5. Retained earnings. Retained earnings. We have Makoko Limited retained earnings as per the statement of financial position. Makoko Limited retained earnings as per statement of financial position. Then if you go back to the statement of financial position of Makoko Limited, we have the retained earnings to be 45,400. 455. 45,455. So we have 45,455. That is the Makoko retained earnings as per the statement of financial position. We also have Makoko Limited. Makoko Limited, share of post acquisition retained earnings of, let's have that of Ojodu Limited. Remember, Makoko Limited stake in Ojodu Limited is 60%. That is, the percentage of acquisition is 60%. You have 60% of the post-acquisition retained earnings of Ojodu Limited. The post-acquisition retained earnings from the summary of Ojodu Limited net asset, the post-acquisition retained earnings is 9,225. So, 9,225. 60% of 9,225, that will give us 5,535. 5,535. Then that of Egbeda. Remember, Egbeda Limited is an associate to Makoko Limited. So it's an associate. So and the stake of Makoko in Egbeda is 40%. Percentage of acquisition is 40%. So we have 40% of the post-acquisition retained earnings of Egbeda Limited. If you go back to the summary of Egbeda Limited net assets, you have the post-acquisition retained earnings to be 5,000. So 40% of 5,000, and that will give us 2,000. Back to the note. Note 4. Note 4. An impairment test as at December 31st, 20x1 showed that goodwill was impaired by 3.5 million naira and the investment in Egbeda Limited was impaired by 0.8 million naira. Remember, the parent company policy as to the valuation of not controlling interest is proportionate share of net asset method. Since the policy is proportionate share, that means the whole of the impairment loss will be attributable to the parent company. So we have the impairment loss on goodwill, 3.5 million, and impairment loss on investment in associate of 800,000. Now let's have impairment loss. Impairment loss. Impairment loss on goodwill is 3.5 million, and impairment loss on investment in associate is 800,000. So if you have 3.5 million plus 800, that will give us 4.3 million. So we are going to deduct the impairment loss. Then note 5. During the year, Makoko Limited sold products to Egbeda Limited at a price of 8 million naira. These goods had cost Makoko Limited 5 million. The cost is 5 million and it was sold for 8 million. That means profit of 3 million had been recognized on the sales. Half of the goods were still in the inventory of Egbeda Limited. That means you calculate the unrealized profit. Provision for unrealized profit. No, we have 8 million is this proceed and the cost is 5 million. So that means profit of 3 million has been recognized. Half are still in the inventory. Half of this is in inventory. So you know the difference is 3 million. Half of 3 million will give us 1.5 million. And the parent stake in associate is 40%. If you calculate 40% of 1.5 million, you know the difference is 3 million. 8 million minus 5 million, 3 million. Half of 3 million, because half are still in the inventory. Half is still in the inventory. Half of 3 million is 1.5. 40% of 1.5 million, that will give us 600,000. So that is the parents take, the unrealized profit attributable to the parent. So after this adjustment, you have 4.5 million, 45,455 plus 5,535 plus 2,000 minus 4,300 minus 600. So we have the retained earnings to be 48,090. 48,090. That is the retained earnings. That is the retained earnings that will appear in the consolidated statement of financial position. Now let's have the retained earnings now. Retained earnings, which is 48,090. So when you sum up the 180,000 and 48,090, then you have the total to be 228,090. 228,090. Then after that, the next item to consider is non-controlling interest. Non-controlling interest. Let's have that to be working 6. Non-controlling interest. Back to the note 8. We have non-controlling interest in subsidiaries are to be measured at the appropriate proportion of the subsidiaries' identifiable net assets. That is the parent company policy. Proportionate share of net assets. That is the policy. So working 6 now. Working 6. We have the non-controlling interest. Non-controlling interest. We are starting with the non-controlling interest at the date of acquisition. NCI at the date of acquisition. Remember, the parent company's stake in the subsidiary is 60%. That means the remaining 40% will be attributable to non-controlling interest. And since NCI is 40%, and the policy is the proportionate share of net assets, that is the policy in note 8. So that means we are going to apply the 40% on the net asset of the subsidiary as at the date of acquisition, which is 119,500. So now let's calculate 40% of 119,500. So we have 119,500, 40% of that. Then we have 47,800. Then we also have NCI, share of post-acquisition retained earnings of Ojodu Limited. NCI share of post-acquisition retained earnings of Ojodu Limited. NCI is 40%. And how much is the post-acquisition retained earnings of Ojodu Limited? If you go back to the summary of the subsidiary net asset, summary of Ojodu Limited net asset, you have the post-acquisition retained earnings to be 9,225. So 40% of 9,225. So now let's have 40% of 9,225. Then we have 3,690. 3,690. If you add it to 47,800 plus 47,800, then you have 51,490. 51,490. So we have an NCI to be 51,490. So when you add it, you have the total equity. Total equity to be 51,490 plus 228,090. The total equity is 279,580. After this, you have the non-current liabilities. Non-current liabilities. Non-current liabilities. So we have 8% loan notes. 8% loan notes, that is 28,000. 8% loan notes, which is 28,000. That of Makoko Limited. So we have 8% loan note of 28,000. 8% loan notes of 28,000. The next item is 10% loan notes. 10% loan notes, we have 10,000 for Ojodu Limited and 12,500 for Egbeda Limited. Back to the note. The board decided to acquire the following investments on January 1, 20X1. 60% of the equity share of Ojodu Limited, 50% of Ojodu Limited, 10% loan notes at par, and 40% stake in the ordinary shares of Egbeda Limited, Egbeda Confectionaries Limited. So there is Makoko has 50% stake in Ojodu Limited, 10% loan notes, and that was acquired at par. So if you go back to the Ojodu Limited 10% loan notes, we have 10,000. So you don't consolidate an associate. That is why we are not going to consider this 12,500. So we have 50% of this 10,000. 50% of the 10,000. So we have 10% loan note. The 50% acquired will be eliminated. While the remaining 50% is what we are going to consolidate. 50% of 10,000. And that will give us 5,000. It is not the 50% acquired that is considered. The remaining ones, the one not acquired, is the one considered here. Back to the statement of financial position. We have deferred taxation. Deferred taxation 60,308 and 8,440. Deferred taxation. Now, let's freeze it in. Deferred taxation. That of Makoko Limited is 60,308. 60,308 plus that of Ojodu Limited is 8,440. 8,440. So if you sum it up, 60,308 plus 8,440, then you have 68,748. So if you sum up the non-current liabilities, we have 68,748 plus 5,000 plus 28,000. Then you have the non-current liabilities total 101,748. 101,748. That is the total of our non-current liabilities. Total non-current liabilities. And that is 101,748. After the non-current liabilities, the next item is the current liabilities. Current liabilities. Now, back to the statement of financial position. We have the trade payables. 25,222 for Makoko Limited and 15,185. That of Egbeda will not be considered. So 25,222, 15,185. So that is trade payables. Trade payables. we have 25,222 plus 15,185. So the total 25,222 plus 15,407. 40,407. After trade payables, the next item is accruals. We have accruals of 7,820 and 5,525. That of Egbeda will not be considered. So accruals 7,820 plus 5,525. 7,820 plus 5,525. Then we have 13,345. 13,345. The next item is provisions. Provisions, we have 8,820 and 6,480. Provisions, 8,820 plus 6,480. If you have 8,820 plus 6,480, the total will be 8,820 plus 6,480. Then you have 15,300. Then the next item, okay, that is all about the current liabilities. So we've considered all our current liabilities. Then the next thing is to sum up the current liabilities. What is the total of our current liabilities? 15,300 plus 13,345 plus 40,407. 40,407. The total is 69,052. 69,052. That is the total current liabilities. Total current liabilities. So we have the total assets. The total of our non-current assets is 2,992.60, and the total of our current assets is 1,511.20. Then the total assets is 450,380. Then we have the total equity. Total equity to be 279,580. 279,580. Then the total of our non-current liabilities is 101,748. Now let's sum it up. 279,580 plus 101,748. Then that is the total of our equity and the non-current liabilities. Then we now add the current liabilities to it, and our current liabilities is totaled 69,052. So when you sum it up, then we have the total equity and liabilities to be 450,380. That is the total equity and liabilities. That is our total equity and liabilities. That is the end of the question. That is the end. That is all about that. Thanks.